Picture a scene from a financial blockbuster. Two Wall Street giants standing face-to-face in a battle for gold's future. In the left corner, Citigroup, predicting a 25% price drop. In the right corner, JP Morgan, forecasting a 20% rise. The difference? $1,500 per ounce and billions in investor gains or losses worldwide. But this isn't just your typical disagreement between analysts after 3 espressos. This is a fundamental clash between two visions of the global financial system, where the stakes go far beyond the price of the yellow metal. The whole story picks up steam in Beijing, where authorities made a move that looks unremarkable, but could be one of the most strategic plays in the global gold market in a decade. The Chinese government authorized 10 of its largest insurance companies to allocate up to 1% of their assets in gold. On the surface, it's just a cosmetic regulatory change. In reality, its potential demand of 255 tons annually. And here's where the game begins. Citigroup and JP Morgan are looking at the same move, but they see something completely different. For Citigroup, it's a desperate bluff, temporary support meant to mask structural weakness in Western investment demand. In their view, when emotions settle, gold will fall below $2,500, as they assess, by 2026. JP Morgan sees the opposite, the first move in a broader Asian de-dollarization strategy. Their question is simple. If the most conservative insurers are starting to buy gold, who's next? And their answer is, everyone. And it's already happening, because insurers from India have already applied to regulators for permission to invest assets in gold. In chess, a gambit involves consciously sacrificing a piece in exchange for positional advantage. Perhaps that's exactly what China is doing, giving up some financial market transparency to create a new, golden foundation for a future reserve system. Citigroup sees risk in this. JP Morgan sees opportunity. To understand why two banks and their intelligent, educated analysts can differ so dramatically in their assessments, we need to look behind the mask of their own interests. Because the truth is, no one looks at the world from a position of complete neutrality. Everyone has their assets, their costs, and their dreams about the future. Citigroup, with assets worth $2.2 trillion, is a bank through and through, dependent on traditional financial instruments. A full 63% of their capital is tied up in loans and bonds, products that live and die with interest rates. When gold rises, it undermines their role as a provider of profitable, predictable assets in an environment of low trust. For them, the Trump growth scenario, rapid economic growth under the new president, is salvation. It restores confidence in bonds, weakens demand for gold, and lets them sleep peacefully. JP Morgan is a completely different animal. With assets worth $4.2 trillion and managing $28.6 trillion in client capital, from pension funds to governments, it's a financial chameleon that can profit from any scenario. For them, gold isn't a rival, but a strategic diversification asset. Their $4,000 forecast is a bet on lasting crisis, trade wars, de-dollarization, and central banks buying 900 tons of gold annually. When Citigroup says gold will fall, they're defending their business model. When JP Morgan predicts $4,000, they're selling a future where they play first fiddle. This isn't cynicism. It's the real economics of motivation in a world where billions of dollars change hands based on the forecasts of a dozen analysts. But there's one giant elephant in the room that JP Morgan especially doesn't want to see. What happens to global gold demand when the price actually heads toward $4,000? This is where the real mathematical problems begin. India and China aren't just the world's largest gold consumers. They're countries where demand for the precious metal has its price breaking point. When the price approaches $3,400, an Indian investor is already paying the equivalent of 350,000 rupees per ounce, an amount that sounds like the price of a car to most of society. And we must remember this is a predominantly agricultural society that, frankly speaking, remains largely poor despite development. In 2013, a similar situation caused a 40% drop in imports. If JP Morgan is right and the price heads to $4,000, gold could lose 300 tons of annual demand from this region alone. Though this is likely an exaggerated scenario, the demand problem could become real. It's a bit like trying to fill a bucket with a hole in the bottom. It doesn't matter how many new institutional buyers you find in China if you're simultaneously losing entire generations of traditional consumers in India. The math is unforgiving. According to World Gold Council data, Asia currently accounts for about 70% of annual consumer gold demand. India and China alone represent over half of global gold consumption and investment demand. If more than half of global gold demand comes from Asia, and nearly half of that demand is price-sensitive, then a rise to $4,000 could prove to be a suicidal leap into the abyss. There's one more fascinating puzzle in this whole story. Why did gold react so poorly to the US bombing of Iran? This was a moment when it would seem that a sharp price surge was inevitable. Yet the price barely budged. The answer is simple, but perhaps still surprising to many. The market had discounted this risk months earlier. When the price jumped 18% in the second quarter of 2024, investors were buying the general sentiment about escalating superpower confrontation. When the next act of this silent third war played out, the actual attack happened. They sold the fact. It's like the COVID-19 pandemic. Gold rose before inflation became a problem, and then many people complained that the metal wasn't rising along with store prices. This event anticipation mechanism is key to understanding the current situation. It's possible that today's gold prices already factor in all potential geopolitical crises for the next 2 years. If so, both Citigroup and JP Morgan could be wrong. The first overestimating the strength of the decline, the second overestimating the growth potential. Another layer of this story that could prove equally important: the quiet revolution in how the world settles its largest transactions. When India pays Qatar for gas in rupees, and China buys oil from Russia in yuan, a fundamental question arises. What will countries do with the surplus of local currencies that aren't as liquid as dollars? The intuitive answer that's emerging more and more strongly: they'll buy gold. In Dubai and Shanghai, physical precious metal trading is flourishing outside the traditional dollar system. These aren't gigantic volumes yet, but the trend is clear. It's estimated that if even 10% of commodity settlements in local currencies translated into gold purchases, it would add about 1,100 tons of annual demand to the market. This is invisible price support that neither Citigroup nor JP Morgan talks about directly. In this context, both banks' forecasts may prove outdated. Citigroup is analyzing a world dominated by the dollar, while JP Morgan is analyzing a world dominated by chaos. The truth may lie somewhere in between, in a world where different regions are creating their own payment systems, and gold becomes the reserve currency for those who don't want to or can't use the dollar. The political casino can't be ignored either. Citigroup is betting heavily on the Trump growth put scenario, the belief that the new administration will restore economic growth, reduce uncertainty, and cause capital rotation from gold back into stocks. It's a beautiful theory, but it has one fundamental flaw. It assumes politics can control economics. That economics is machinery, not a living organism, the chaos of millions of overlapping decisions. Reality is more complicated. Trump's policies, tax cuts combined with protectionism, is a mixture that, as history shows, can lead to inflation. Tariffs are a tax that consumers pay, and fiscal stimulus means more money in circulation. If we add the geopolitical tensions that inevitably accompany America First policies, we get a cocktail that traditionally supports gold, not weakens it. JP Morgan seems to recognize this, betting on structural forces that transcend political cycles. Their vision of the world is one of permanent uncertainty, where trade friction, stagflation, and de-dollarization create sustained demand for gold regardless of who happens to be sitting in the White House. Beneath the surface of all narratives, Chinese insurers, de-dollarization, or Trump's policies, lies a less spectacular but crucial factor: real interest rates. These have long-term determined whether gold shines or dulls. Citigroup may not say this outright, but their scenario assumes classic macroeconomic cleansing. Inflation falls, the Fed no longer needs to be dovish, and real rates rise, which takes oxygen away from gold. JP Morgan is betting on something opposite: persistent inflation, structural stagflation, a weakening dollar, and negative real rates as the new normal. In this world, gold isn't just an asset, it becomes an escape from the logic of Western central banks. And the DXY index? If it starts falling despite the Fed's hawkish declarations, it will be the first signal that JP Morgan's vision is winning. But after 2022, this correlation began to break down. After the West seized Russian foreign currency reserves, the consensus that dollar assets are politically neutral disappeared. The developing world began treating gold not as an alternative to the dollar, but as an insurance policy against its politicization. The inverted U.S. Treasury yield curve, a classic recession signal, today doesn't translate into panic in treasuries, but into stable gold strength. So it seems it's no longer just about inflation or interest rates. The new driver of gold demand is likely a crisis of confidence in the very architecture of global reserves. It's worth noting how banks formulate their forecasts. Citigroup titles its report Gold Below $3,000, despite its main scenario assuming consolidation around $3,300. JP Morgan does the opposite. It boldly states gold to $4,000, though the document itself admits the path to this price will be bumpy. These aren't random decisions. In a world where headlines are read more often than full reports, the title becomes a narrative anchor that can influence market behavior. In the era of algorithmic trading, where machines react to keywords in real time, such headlines can instantly trigger market movements. Moreover, many retail investors, especially those operating through mobile apps, react not to data, but to emotions contained in the headlines. This makes such narratives become self-fulfilling prophecies. If enough market participants believe in $4,000, they might push gold there themselves. In a world where forecasts often become self-fulfilling prophecies, this psychological aspect may prove as important as fundamental analysis. If enough investors believe in JP Morgan's scenario, that alone might push prices higher. And conversely, if Citigroup's scenario gains popularity, it could contribute to the realization of pessimistic forecasts. As John Jennings writes in his book, The Uncertainty Solution, How to Invest with Confidence in the Face of the Unknown. So what is wisdom? I think it's best captured by a concept known as the hierarchy of wisdom, originally developed by organizational theorist Russell Ackoff in 1989. In this model, Ackoff divides the types of things we hear and learn every day into four categories: data, information, knowledge, and wisdom. He then classifies them according to usefulness and availability. Wisdom is rare and most useful, while data is abundant and not very helpful. I don't know if we'll reach the level of wisdom here, but let's at least try to achieve the level of knowledge. The chart showing the share of the dollar, euro, and yuan in international payments, which for many people is proof that there is no de-dollarization, but de-euroization. My private hypothesis is different. Please note that until the end of 2022, the dollar and euro behaved like mirror images. What one currency lost, the other gained. But a fundamental change occurred. The dollar, despite its share increasing, did not fully recover what the euro began to lose. A new arrangement is emerging, dispersed, unstable, based on dozens of regional currencies and bilateral agreements. In such a world, gold, as a neutral, extra-systemic store of value, may play a role that other currencies cannot. The next chart shows the share of gold, euro, and dollar in global foreign exchange reserves. At first glance, the data suggests that gold's share in global central bank reserves rose from 10% to 20% between 2018 and 2024. This seems impressive, but after accounting for gold's price increase and record purchases, it turns out to be surprisingly low. When the dollar and euro are losing shares, and gold is growing both in price and quantity, its share should have increased more. Possible explanations include undervalued book valuation of gold, often at historical prices, keeping part of reserves off central bank balance sheets, e.g., in sovereign wealth funds, or growth in reserves in other currencies, such as yuan, rupee, riel, or dirham, which are not yet properly separated in global compilations. As shown in this chart from this year's World Gold Council survey, 95% of central bankers believe that gold reserves will increase in the next 12 months. This response trend is also growing. In 2021, only 52% of bankers gave such an answer. Then year by year, these responses increased by 10%. 76% of respondents believe that in 5 years, gold will have a moderately or significantly higher share in total reserves compared to 69% last year. The responses were also quite consistent between central banks in developed economies and emerging markets. So how do we navigate this jungle of conflicting forecasts? The best strategy seems to be recognizing that both banks may be right in different time horizons. In 2025, Citigroup's consolidation scenario may dominate, when Chinese purchases provide a floor of $3,100, but record price levels create a psychological ceiling of $3,500. By 2026, JP Morgan's scenario may materialize if recession risk crystallizes, trade wars escalate, or Chinese purchases expand beyond insurers to pension funds and commercial banks. A decisive break above $3,500 could trigger momentum-driven moves toward $4,000. Practically, this means tactical caution in 2025, avoiding aggressive positions at prices above $3,400, but simultaneously strategic accumulation for 2026 when potential risks may materialize. The dispute between Citigroup and JP Morgan is more than a difference of opinion about gold prices. It's a fundamental clash between two visions of the future global financial system. Citigroup's scenario is a return to the pre-2020 world, the dollar as an unquestioned hegemon, growth driven by American consumer optimism, gold as a relic from times when people didn't trust governments and central banks. JP Morgan's vision is a multipolar world, de-dollarization, gold as a reserve currency for countries that don't want to or can't rely on the American financial system, permanent uncertainty as the new normal state of affairs. The truth probably lies somewhere in between. Personally, I lean closer to JP Morgan's version, but one should always account for the possibility of sitting in an information bubble. Even while trying to be objective, various psychological factors affect us, such as tendencies to avoid doubt and inconsistency. As Charlie Munger wrote in his text, The Psychology of Human Misjudgment, Lord Keynes pointed out about his exalted group of intellectuals at one of the world's greatest universities that it was not the inherent difficulty of new ideas that prevented their acceptance. Instead, new ideas were not accepted because they were inconsistent with old ideas already in place. What Keynes was reporting is that the human mind works much like the human egg. When one sperm gets into a human egg, there's an automatic shutoff device that bars any other sperm from getting in. The value of gold isn't measured only in dollars. It's measured in the investor's peaceful sleep, in the certainty that part of their wealth is safe regardless of what happens in the world of politics and finance. In this context, both Citigroup and JP Morgan are just actors in each investor's personal play called capital protection. The most important thing is understanding that investment bank forecasts are not neutral. Everyone has their interests, their assets, and their visions of the future. Citigroup defends a world where traditional financial instruments dominate. JP Morgan promotes a world where complexity and uncertainty create endless opportunities for profit. Ultimately, regardless of whether gold will cost $2,500 or $4,000 in 2 years, it will still be gold, the metal that has survived the fall of all great empires and currency systems of the last 5,000 years. And I assure you, it will also survive the dispute between two banks from Wall Street.